The Federal Reserve just ran out of cash, and China just ran out of patience. As of this morning, the reverse repo facility is nearly zero, and Shanghai just nuked speculative silver positions by 57%. The safety nets are gone. Stop looking at the stock market, look at the plumbing. For 2 years, the reverse repo facility or RRP acted as a sponge. It stabilized the system. But as of January 16, 2026, that sponge is dry. The New York Fed data shows the RRP balance is effectively zero. This changes everything. Previously, when the Treasury issued debt, money came out of the RRP. It was neutral, but now the Fed is preparing to inject $55.3 billion starting next Tuesday. This is not a rotation, it's a pure money printing. So why are they doing this? Because $7 trillion of US debt matures in the next 12 months and because bank reserves are below the critical threshold of $3 trillion. There is no one to absorb the debt. They're printing money to pay credit card bill. Without the RRP buffer, every dollar injected goes straight into inflationary assets. The market thinks this is bullish, and I argue it is the most dangerous setup since 2020. Now let's look at the metals market. The map is being redrawn. We know physical silver is flowing east, but Shanghai Futures Exchange just dropped the hammer again. They slashed silver position limits by 57%, from 7,000 watts down to 3,000 watts. Mainstream media calls this regulation, I call it what it is, capital controls. This is designed to curb excessive speculative players in China who are betting on a currency devaluation. They do this all the time, and let me tell you, it works way better than margin hikes. Margin hikes just make trading expensive, position limits force liquidation. So hold on to your hats. When an exchange forces deleveraging like this, it creates a temporary liquidity vacuum. We could see a sharp wash out as Chinese speculators are forced to sell, followed by a massive rip higher as physical supply reality sets in. But let me tell you, this comes much later. Before we break down the mechanics, if you want to track the real plumbing of the financial system and not just the headlines, make sure you're subscribed. Now, let's look at the house of cards. You need to understand the systemic risk. We are tracking a parabolic move in silver prices, and parabolas always correct. But this correction won't just be technical, it will be also existential. Why? Because the derivatives market is a house of cards. The Bank of International Settlements, or the BIS, is watching this closely and they are worried. Here is the dirty secret: for every ounce of physical silver out there are hundreds of ounces of paper silver traded. The worst banks are typically the ones shorting this paper to provide liquidity. So if prices continue to climb, these banks face unlimited losses. And here is the risk: for the hedge funds piling into long positions. If the banks on the other side of your trade go out of business, you don't get paid, and the whole chain snaps. This is why the system needs a flush. With the RRP at zero, banks cannot afford a squeeze. So if we get even a minor spike in treasury yields next week, which is likely given the refinancing wall, they will force a washout. Margin calls will go out and hedge funds will be forced to liquidate their winners, which is silver, to cover their losers, which are bonds. We could see a 15 to 20% drop in silver prices in a matter of days. And this is not a bear market call, keeping that in mind. It is a safety valve release. If you need more evidence, look at the silver to crude oil ratio. Historically, this ratio averages around 0.2 to 0.3%. Today, it is flashing extreme readings. Silver is expensive relative to the energy required to mine it. This dislocation signals one of the two things that must happen. Either crude oil explodes higher to catch up, or silver crashes in a vicious mean reversion event. Given the Shanghai crackdown, the odds of a short-term silver correction just spiked. If you are buying here, you are fighting the Shanghai exchange, and this is a fight you usually lose in the short term. So here is the strategy for the next few weeks. We are in an off-white zone for aggressive longs. With the reverse repo facility at zero, the system is fragile. I'm watching two critical indicators. First, this is the 10-year treasury yield. If it crosses 4.5%, the silver correction begins immediately. And second, and this is the alpha, I'm watching silver lease rates. Lease rates are the cost to borrow physical metal. Right now, they are elevated. This signals physical tightness. But here is the trap. If lease rates start to drop while the price is this high, it means the physical shortage is resolving. If that happens, the squeeze is over. And the Shanghai limits are the wild card. Wait for the washout from the 57% cut. Let the leverage speculators get flushed out. Then and only then do we work to re-enter physical positions. Cash is not trash when volatility is repricing. Cash is optionality. If you found value in this deep dive, smash the like button. It helps the algorithm get this intel to the people who need it. The next 48 hours are critical. Stay liquid. I will see you on the next one.